Good morning, everyone. Welcome to the breakout session for the Agribusiness Management track. Before I introduce today's speaker, I'd like to mention that we will be offering one CEU in professional development for attending this breakout session. We have the details at the end of this session offering that CEU and how to access your credit. We appreciate the opportunity to partner with the CCAs to offer this additional benefit during the programming. Right now, I'm happy to introduce KRISTINE TIDGREN, presenting a 2021 tax update, what we know and what we don't know. Tidgren is an adjunct professor at the Agricultural Education and Studies Department at the Iowa State University. She works in the Center for Agricultural Law and Taxation, where she focuses on studying and interpreting the laws impacting the ag industry. KRISTINE focuses on ag taxation specifically, and before coming to ISU, she worked for a legal publishing company as a practicing attorney. She received her JD from the University of Texas at Austin and her bachelor's in journalism from Iowa State. She grew up on a farm in West Central Illinois. And now I'd like to introduce KRISTINE.
Thank you, Jessie, and thanks for having me here today. I just am really glad to be able to talk to you about a topic that I'm kind of passionate about, and that's taxation, agricultural taxation, the impact of these new laws, the impact of these items on your farming business. And so today we have great opportunity to have a conversation. So just because we're remote doesn't mean that we don't want you to ask questions and make this an interactive presentation. So what I'm covering is what I've been getting the most questions about over the past couple of months. But if there are items that you're curious about, you'd like more information about, just jump in the question box, type in your question, and Jessie will be able to bring those to us so we can talk about the things that most matter to you. So 2021 has started off much the same way. I think that 2020 ended with some uncertainty as to the future, with a lot of new programs being rolled out to try to compensate small businesses for losses suffered because of the COVID pandemic. And we've just had a lot of change. And so the first part of this presentation, I just want to review a couple of the big things that have really impacted a lot of farmers out there. And I'm sure many of you have been working with your lenders, have been working with your tax advisors to try to figure out exactly how these laws apply to you and your business. And so I'm just going to review PPP to start with, the Paycheck Protection Program, answer some common questions that have been coming up, and just kind of discuss that a little bit with you, look at the changes that were made with respect to EIDL advances, the tax changes, how all this will impact your tax return that you're busy working on with your advisor as well. We also want to talk about the employee retention credit, which is a really big new benefit. I say new because in many cases, people were not eligible for it in 2020 because they had Paycheck Protection Program loans. And the rules back then, the law said you couldn't have both, but the new law has changed that. So there are now lots of small businesses that are eligible to go back and take advantage of the employee retention credit as well. Then I also just want to make sure that you're all aware that if anyone had issues where they had employees, or as a self-employed person, they themselves had to take periods of leave from being able to work because of COVID-related reasons, even if they had to take time off from their business to be with children who were being schooled online, there's new tax credit available for that as well, and you'll be taking that on your 2020 return. And if you need to accumulate that leave in 2021, you'll be taking that leave on your 2021 return. So there's lots of other items that were passed in this new legislation that went into place at the end of 2020. We're not going to talk about those. Many of you received a stimulus check in the mail again in 2021. That was another part of this new law. There are new net operating loss rules for farmers. We're not going to dive into that, but just lots and lots of law that went into place at the end of 2020. And as you know, there is negotiation going on right now for another, roughly the proposal would be for $1.9 trillion of COVID relief. So we don't know yet what's around the corner. What we do know is that the vote in the House probably won't take place because right now the items that the committees are discussing are just sort of being rolled out. So the first vote in the House probably won't take place until the week of February 22nd. So now is kind of a time to keep watch over what's around the corner with the new relief that's being rolled out as well. And so with that said, I'm going to launch in and tell you that at Iowa State, at our Center for Agricultural Law and Taxation, we really do like to keep up with you out there in the industry, those of you with the boots on the ground, the farmers in the field, the advisors that provide advice to you all. And one of the primary ways we do that is through a website. And you'll have access to these slides so you can go back and look at anything in more detail, because some of them we won't cover in detail. I want to make sure that we maximize the time we have today to talk about the things that are most important. But I did put the web address to our website out right here. We have a lot of articles, we have a lot of resources that it's just perhaps will be of use to you throughout the year. And as new legislation, for example, gets passed, we would just invite you to come out and read about it or reach out to us if you have questions. So let's talk about first. Oh, Jesse, yeah.
I wanted to jump in. We had a question come in, and before we got too far off of our topic, our first slide there, the question is, will the federal government be sending a 1099 or some sort of mechanism of reporting the stimulus payments made? And does that go somewhere on our 1040s?
That's a good.
The stimulus, we might have to clarify, since there are so many different stimulus packages, maybe talk a little bit about that economic impact payment versus the PPP and ERC stimulus pieces.
Sure, that's a great question. I mean, what a confusing year, right? With money coming from different sources and trying to keep track of it all. So it's been interesting with the stimulus payments, what most people usually are talking about, and I'm assuming you're talking about the economic impact payments, which were those payments that were sent out roughly to most Americans, right? They started to phase out with married filing jointly if the income was 150 and above, 150,000 and above, but otherwise a big chunk of Americans got $1,200 each, $500 per children. The first round, of course, was issued last May. They started rolling out then, and then another second round started coming out in 2021. And in 2020, as soon as that payment was made, there was also a letter that came in the mail, and it was signed by the president. So that might remind you. It was a letter that summarized what the payment was that you received. And that had an IRS notice number on it. It was actually a formal IRS notice, which was the only notification that we will receive in the mail regarding those stimulus payments, the economic impact payments. You won't receive a 1099. It's not taxable income. It was an advance on a tax credit. So yes, your tax professional is going to need to know how much you received from the government for those stimulus payments. And if you have that letter, you're supposed to bring that to your tax appointment. Now, the interesting thing is, for the 2021 payments, there was also supposed to be a similar letter. I haven't heard from anyone who's received that letter. So there is no corresponding letter in a lot of cases, any form for you to bring to your tax appointment. Now, what IRS has recently done is opened up an online portal where the taxpayer can go out, set up an account, and pull up the amount of the payment that they received. So if you don't have a record, a bank deposit record or something, then you work with your tax provider to see what exactly they need, because what happens is the amount of the payment that you received will go on your 2020 return. Even the money that was received in 2021 is going to be on your 2020 return, not as taxable income, doesn't impact your tax situation at all. It was truly free money, but it has to be reconciled because some people in 2020 or early 2021 didn't actually receive the full amount to which they were entitled. And that would have come about, for example, if you had a baby in 2020. IRS didn't know that you had a new baby, and so they sent you a check based upon your 2019 income. So if your situation changed and now you had a dependent, then you did not receive the $500 initial payment that you would have received in 2020. When you file your 2020 return, you get to claim that. So you'll get additional money. You also may have, for example, a college student who was your dependent in 2019. And you didn't get any money for them this year because they were not under 17. So they were not eligible for the child payment. So nobody got any money. But in 2020, maybe they got their first job, they became independent. They're no longer a dependent on your return. In that particular case, when you file your 2020 return, if they file as an independent taxpayer, they'll get their stimulus payments when they file the return. So you'll make those young folks who are just starting out very happy. So hopefully that addressed your question. It was kind of a long answer, but it is important because it does go on your return, but don't worry, it won't hurt you, because the other one thing I want to make sure you understand is the way the law was written was really one of those very few heads you win, tails you win laws. It never works this way, but this law did. And it said, okay, we're going to use your 2019 return if we have it. Otherwise, sometimes they use 2018. But if we gave you too much money, let's say that in 2019 you had a child under 17, but in 2020 they turned 17, and you would really no longer be eligible for the $500. Well, guess what? When your tax return preparer calculates the amount of credit that you're entitled to, they'll realize that you were overpaid, but the law specifically says you do not have to pay that back. So a lot of people got more than what they were technically entitled to under 2020 tax rules, but they don't have to pay it back. And then some people that didn't get all the amount that they were entitled to, they'll get to claim it when they file the return. So it's not going to be bad, but it's a great question about if you have the letter, bring it to your tax professional. Otherwise, they'll probably have to work with you to get you on that portal to get that information up. All right, let's move on into PPP, because a lot of small businesses have really been able to tap into some sources of money that the government has made available through this Paycheck Protection Program. It was really the primary vehicle that was authorized through the CARES Act to get money in the hands of small businesses that were really struggling because of coronavirus. And so you can see here, the initial program, as you know, ended August 8th. And at that time, $525 billion of loans had been made through the program. And there was still also money left on the table because by that point, the period ended and Congress said no more loans, even though there was still $133 billion left. What happened in December when Congress came out and reauthorized the program is they allocated $284 billion for the new PPP program. And it really has three components, right? The PPP now, and I'm just going to say PPP, it's a little easier than Paycheck Protection Program, but it authorized new first draw loans. So if you're someone who did not take advantage of PPP in 2020, then you are suddenly eligible for a new loan for the first time. So it's called a first draw loan. If you got a first draw loan in 2020, so if you were a farmer who received a first draw loan in 2020, but your loan amount was very small because your net Schedule F income was very low, the new law gives us a new calculation for self-employed farmers that allows you to now receive an increase to that original loan. So it's not going to be a new loan, it's going to be an increase to your original loan. Then the third prong of this new reauthorized extended PPP program is what we call second draw loans, which is a whole new loan that you get, and it's very much like the first loan. So let's say you got a $20,833 loan in 2020. If you can show that your gross receipts declined by 25% or more in 2020 as compared to 2019, and it's really only one quarter, we'll talk about this a little bit as we go along, then you're eligible for another $20,833 loan. And when I say loan, right, we're talking about loans, but most of you are aware the PPP program is a forgivable loan. What does that mean? Well, it's issued through your bank, it's issued through your lender, but you get the money, you spend it in the way that you're entitled to spend it. And in the case of a self-employed farmer, the way you're entitled to spend it is owner compensation, meaning that you get to actually have that money as income to yourself, kind of like a paycheck for the self-employed. And you get to have that money and it will be forgiven, which means you don't pay it back. And because of the new laws we have, it won't be taxed and it won't impact the deductions that you are eligible to take on your tax return. So it really is, in this case, free money to be used by small businesses who are facing uncertainty because of COVID. And so let's just quickly review the details of this and answer questions that you might have with respect to this program. So the first draw PPP loan is for those who did not receive a loan in 2020. So some of you may have been left out because your Schedule F income, your net income that we were required to use in 2020, it might have been zero. It might have been a negative. And now the law steps in and says, oh, we have a new calculation for farmers. If you didn't qualify in 2020, you get to have a loan in 2021 based on the old rules, which really the big thing is the maximum amount is $10 million. And then the thing is, you don't have to show a decline in gross receipts if it's your first draw loan. So if you didn't receive a loan in 2020 and you're eligible in 2021, you don't have to do a gross receipts calculation and say that they declined by 25% or more. It's irrelevant. You qualify based upon your net Schedule F income and your affirmation that economic uncertainty makes the loan necessary. We'll talk about that in a minute. So what is this amount that we get as a Paycheck Protection Program loan? Well, the amount you get is based upon what the law calls payroll costs. And so, of course, if you have employees, it's based upon what you pay your employees as wages. But the law also says if you're self-employed, you should be able to have some compensation for yourself. And so the way that they have come up with allowing us to get this compensation is by looking at our tax return. So for this new first draw loan program, you get to look at either 2019 or 2020 if you have it prepared or drafted out. If you're a farmer, you look at your Schedule F and you get to look at line 9, your gross income. Now you take that amount and you're going to have to take away any payroll costs from that amount because we don't want to double dip. But then you add back in any of your payroll costs And then you divide that by 12 and you multiply it by 2.5 to get 2.5 months average pay for that is the amount that you're going to get for your loan. So let's look at an example in just a minute after we talk about one other key term that's really important to understand when we talk about PPP, and that's covered period. So as soon as your loan is disbursed, as soon as the bank gives you your money, you have an 8 to 24 week covered period within which to spend those proceeds. Now, if you have employees, it means that you'll pay your employees their salaries. There's other non-payroll expenses that you can actually use as well, as long as you don't exceed 40%. You'll get full forgiveness on those non-payroll expenses. But for self-employed people, there's really nothing to do except take your owner compensation. So if you get the $20,833 in owner compensation, that is your paycheck, so to speak. And so really the technical best way to do this is to write yourself a check, and bingo, you've spent the money the way it's intended to be spent, and you should be eligible for full forgiveness for that. So there's a new application that's out there. One thing I want to point out is the certifications that do have to be made on that application. And one that we have to affirm is that the current economic uncertainty makes this loan request necessary to support the ongoing operation of the applicant. So when you apply for PPP, you are certifying that the economic uncertainty makes the loan request necessary. So necessity matters. It's a kind of an ambiguous affirmation that we're making. And we do have some safe harbors out there that have been put in place that say, really, if your loan is less than $2 million, you're going to have been deemed to have made this in good faith. But if you're somebody that is rolling in the money, not common these days, but if that's the case, you just do need to think about that necessity determination, because you could be audited after the fact, and that an audit that would somehow find that you had not made that certification in good faith would require you to pay that money back. So let's look at our line 9 on our Schedule F, which is the line that we use now to determine our gross income, which is that amount we get to divide by 12 and multiply by 2.5 to get our owner compensation replacement. And so there's the line 9, and that's the important line. It's gross income, right? That's before all of your expenses. So we do have to lower it to $100,000. So you don't get to exceed that for any owner compensation. But we'll look at an example in just a minute about how that works. And this new farmer rule, right? Last year you had to look at line 34, which was the net line after you took away all your expenses. So a lot of folks had low net line 34s. A lot of folks had 0, or some had negative, because of the way that we handle depreciation, right? You trade equipment now, your income from that trade goes on a different form, 4797, you pay tax on that, but the offsetting depreciation goes on your Schedule F, so your Schedule F income is drawn down. So that was a little bit of a handicap to those who were seeking a PPP loan. And Congress listened and said, okay, for farmers, we're going to do it different in 2021. And we're going to allow people to use their gross income. And you can use that new calculation for 3 things. If you didn't get a loan in 2020, you can get one now. If you, and you don't have to show a decline in gross receipts if it's your first time. If you did get a loan in 2020, but it wasn't very much, you can now use that line 9 to get an increase. And then finally, if you did get a loan in 2020 and you have a 25% or more decline in gross receipts for any quarter in 2020 as compared to 2019, you can get a whole nother PPP loan. And so this new farmer rule, who's it available to? Well, it's available to sole proprietorships, independent contractors, self-employed individuals. It doesn't apply to partnerships. It doesn't apply to C Corps. It doesn't apply to S Corps. So even though some of those entities will use a Schedule F, there's nothing in the rules that allows us to use this special rule. Those entities have their own calculation rules. So we have to look at line 9. We have to cap it at 100,000. You can't exceed that. But then you divide by 12 and multiply by 2.5. So let's look at an example. So let's say this is what my 2019 Schedule F looked like. So when I went to talk to my professionals and my lender last year, because I wanted to get a PPP loan, they looked at my line 34 Schedule F and they said, well, you have negative $6,500. You do not qualify for a PPP loan. So I went home, right? Well, this year, now we look at line 9 instead. And on my Schedule F, my gross income was $130,000. So I am now eligible. And you can see on this Schedule F that this particular farmer had employees. So I'm also going to look at line 22. I paid $20,000 in labor. And I'm going to look at 23, which is my pension and profit sharing plan for my employees. And there's another line 15, which doesn't have anything in this particular Schedule F, but that's another line with benefits that I would also get to look at. And so how does all this look when I'm trying to figure out what loan I'd be entitled to? Well, I would now take my $130,000. I'd subtract out those employee costs I talked about. I'm still over 100,000, so I would have to lower that to 100,000, and then I get to add in my payroll costs back. So I take that $121,500 in this example, divide it by 12, multiply it by 2.5, and I'm eligible for a $25,000 loan. $20,833 of that is my owner compensation. Now let's look at how an increase works, right? So this is where in 2020, my Schedule F looked like this. So I actually had a line 34 net income. In this case, it was $15,000. And so I said, well, what the heck? It's a small amount, but I might as well get a loan, get it forgiven, get the money that's available because I am facing economic uncertainty. So this particular farmer went ahead and, would have gotten the loan in 2020. And based upon this Schedule F, and you can see on line 9, this Schedule F had gross income of $130,000, but the net was only $15,000. So in this particular example, the loan in 2020, the first draw loan that this farmer got was $3,125, not very significant. The new law says, okay, you can go back to your lender, show them your Schedule F, and you see that you have that $100,000 sitting there, so you can get the difference between what you would have gotten, the $20,833 and the $3,125. So in this case, this farmer's eligible for a $17,708 increase. Now that's not a new loan. That's just an increase to the loan they got in 2020. Straightforward process. Go to the lender requests the increase, the money's there, and it's just, in this example, going to be additional owner compensation for the farmer.
Hey, Kristine, I'm going to jump in. I have another question out here. And
sure.
It involves this increase on the first round draw. So if one applies for an increase in a first round draw loan, does it start a new 8 to 24 week covered period, or does the covered period remain the same as the original or the first draw?
That is a great question. And I just have to say at the outset that the guidance has not answered that question very clearly. In fact, it hasn't really answered that question. So it does seem as though our lenders in Iowa, and I think a lot of the lenders in Illinois, are looking at this differently than getting a first draw loan in 2021. And they're looking at it as though it's going backwards to that initial loan. So you're not starting a whole new covered period. Now, we could get guidance tomorrow that says something different, but what it appears is that it is just going to be money that you are not subject to that full 8-week covered period once you get it. That's what it seems. And I know the SBA office in Iowa put out an announcement last Friday that said as much, that that's how they're interpreting it. And so it doesn't restrict farmers from then qualifying for a second draw loan. What they're suggesting is that the increase is dispersed and spent, and then they're saying that farmers are eligible for a second draw loan right away after that. But again, we haven't heard that from the national office. That's been the difficulty about this program, is that not all of the really important questions have been answered. But the deadline, I don't think I've even said that at this point, the deadline for when this all ends is March 31st. So we don't have a lot of time. So we really have to sort of move forward with what we know. So worst case scenario, we apply for the increase, we apply for the second draw loan, we get both. You know, if something were to come out later that says you're not eligible for forgiveness, it would seem like only one of those would be taken away for forgiveness, and then it would be a loan that you would have to pay back. But I don't expect that to happen, but I'm just kind of giving you full disclosure in terms of where there are gray areas. We have to just act with caution. So when we talk about a second draw loan, this is only applicable to those people who actually received a first draw loan. And most of the time that's the first draw loan in 2020. So I got my PPP last July. And the one thing too about the increase, I didn't, it's in the slides, but I don't think I said it because it's super important. You're not eligible for an increase if your first loan was already forgiven. That's in the rules. That's why I made a sad face on that slide. Seems like one of those unfair rules, but it's only available if that loan is still kind of open. But moving on to second draw loans, these loans are available to businesses that can show that they had a revenue reduction of 25% or more in 2020 as compared to 2019. And there are two ways to show this. You can show it for only one quarter. So technically you could actually have more income in 2020 than 2019, but if you had one quarter where you had that gross, the gross receipts were 25% or more decline as compared to 2019, then you're eligible. It's like a box that has to be checked, and once the box is checked, you're in. And if you can't check the box, you're out. Now, the other way you can be eligible is if you just want to use your tax return. You can work with your preparer, and you don't have to present it now, but you do have to present the final return at the time that you get forgiveness. But you can use your 2020 return, and if you can show that your 2020 gross income, and you have to add back in cost of goods sold, but if you can show that that is 25% or more less than 2019, then you can also check that box and be eligible for the second draw loan. Otherwise, really the only difference in the second draw loan is there's a few requirements that don't apply to a lot of farmers, like you can only have 300 or fewer employees instead of 500 or fewer employees, and you can only have a maximum of $2 million as opposed to $10 million. But for most of us, the second draw is going to work exactly the same. So Schedule F of someone who got the loan back in July, their first draw loan, doesn't matter if it's forgiven or not. The only thing is you have to have paid the money in the way it was intended to be paid. So it can be forgiven, it can be not forgiven, that part doesn't matter. But using this Schedule F now, assuming you have that 25% reduction, you would be eligible for a $20,833 loan. This is above and on top of the PPP loan that you received in 2020. So that's how the second draw works. Forgiveness, it's really important that we spend these proceeds the way they're allowed to be spent, right? So we have payroll costs. So if you're self-employed with no employees, it's a piece of cake because your only money that you're receiving is for owner compensation. You just write yourself a check and that's it. If you have employees, then you get to pay your employees with the money as well. But the law also says even though the PPP was based upon payroll costs, you can spend up to 40% of it on non-payroll costs. And there's 6 eligible categories. We're not going to go through those today, but you know, you're probably familiar with them, or check with your advisor about them. Rent, mortgage interest, some new categories like PPE, input costs and things like that. You have to spend those on eligible expenses. And if you do, that's when we say forgiveness. What does forgiveness mean? It means the loan is no longer on your books and you don't owe it back. You don't have to pay it back, and it doesn't hit your tax return. It's really phenomenal. Now, the key thing for forgiveness, what the rules say is we have an 8-week to a 24-week forgiveness period. And it does say in the forgiveness guidance that was issued January 19th that the owner compensation and payroll costs are prorated based upon your chosen coverage period. So what does that mean? Well, if I'm looking at owner compensation, then I want to get to that magic $20,833 if I had at least $100,000 of gross income on my Schedule F. To get there, I really have to have, and I said on this slide 10.5, I think it's technically 10.7 week covered period, because you have to do the math to figure out how you get there based upon the 100,000. And so 10.7, roughly 11-week coverage period would be required according to the guidance that came out to get you that full forgiveness of that owner compensation. Your payroll costs are also prorated. So if you're paying an employee, how much you can pay them is going to depend on how long your coverage period is. So let's just talk about a couple of questions with the caveat that some of these are not known for sure. These are just what we have the guidance for, our best determination based upon the guidance that's been given. And the first question is, can you get a first draw loan in 2020 and a second draw loan in 2021? And the answer is yes. That's what the second draw loan is for, as long as you can show that you had a 25% decline in gross receipts. So yes, that's what it means to have first draw, second draw. You received the PPP in 2020. Now you're eligible for a whole nother loan in 2021, and you could get up to the $20,833 for each one as a self-employed farmer. But for the second one, you have to show the 25% or more decline in gross receipts. Must you have received forgiveness for your first draw loan to get your second draw loan? And the answer is no. You just have to have spent it on eligible expenses prior to dispersing the second draw loan. Here's kind of the dicey one. May I receive both a first draw loan and a second draw loan in 2021? And here's kind of a gray area that some lenders are allowing this, but when you look at the forgiveness guidance, it seems like there is a timing problem, because the guidance says you have to have at least an 8-week coverage period. It says covered period. It says that your covered period for your first draw loan cannot overlap with the covered period for the second draw loan. So it would seem like if I get my first draw loan today, I would start my covered period for my first draw loan. It would have to go at least 8 weeks, and that would have to be ended before I could qualify for a new covered period. But I think some lenders have been giving first draw, second draw loans back to back. But I think the forgiveness guidance says you have to have an 8-week covered period for each one, and they cannot overlap. So that's my concern with that. What about an increase in 2021 and a second draw in 2021? And this we kind of talked about. Somebody already asked this question, and this one, we don't have the guidance that restricts this. There's nothing that says right now that the increase starts a new covered period. So we don't have clear guidance that you can do it. But again, like I said, I know that the SBA office in Iowa just said on Friday that you can. So work with your lender on that, and work within whatever you're comfortable with. Some people are more comfortable with gray areas than others. What about some other common questions? Can a partnership use the farmer rule? We've had that question a lot, and the guidance does not allow you to do that. When I say the farmer rule, I mean, can you look at your gross Schedule F income of your partnership? Because that would be a lot better for partnerships too, right? But the rules for partnerships have a special calculation for partner compensation, and that is based on the net income passed through on the K-1. Jesse, did you have a question? Did something pop up that somebody wanted to ask about?
Yes, I do. And you're actually talking about this exact point. The question is, if I started a farm business LLC in 2020 and did not apply for the PPP, what would the application in 2021 under the new rules look like? Now, this LLC appears that it would be filing as a Schedule C and not as a Schedule F.
Oh, that's a big distinction. So you have to look at the rules that deal with new businesses to be able to determine your eligibility. And we don't have time to go into all the details of that because the rules have special month calculations and things like that with respect to the gross receipts. If it's a new one, you'd be looking at the first draw loan, but you still have to follow those rules. But with respect to the LLC itself, what the rules say is if you are an LLC, you will calculate your loan based upon the tax treatment of the LLC. So if I'm a single member LLC, under the tax law, I'm disregarded. I'm the same as a sole proprietor, and I would be able to use, if I was a farmer, my Schedule F, and I would be able to use the new farmer rule. I'd be able to use line 9 of the gross income. Now, in your question, in your example, it looks like the LLC is not a farming business, it's non-farming, so it's a Schedule C. Same thing, you can use the Schedule C, you would use line 31, the net income on line 31. Only farmers get the special gross income rule, and it was really driven by the fact that farmers are the ones who are always trading in that large equipment. They're always having that huge influx of 4797 income that's offset by that huge amount of depreciation, Section 179 bonus on the Schedule F. So the idea is a farmer's Schedule F is going to misrepresent the actual income the farmer has, whereas a Schedule C is usually more indicative of the actual income that the Schedule C owner receives. So if I'm an LLC that's single member, Schedule C, I'll use line 34. If I'm a single member farmer, I get to use line 9 on my Schedule F. If I'm an LLC partnership, then I have to use the partner rules, the partnership rules, which means I get to count my payroll that I pay to all my employees, but partners are not employees. So what I use for partner compensation is going to be the net self-employment income that I've passed through to them on the K-1. And so I get to add that on top of my other payroll costs. Same rule, divide by 12, multiply by 2.5, because it's going to be 2.5 months worth of the eligibility. And then there's a unique situation that arises with husbands and wives under IRS rules. You realize that you can have a farming partnership where you're both essentially partners in the farming business, and IRS, for simplicity's sake, says, okay, in that situation, you don't have to file a partnership tax return. Instead, you get to each file your own Schedule F, and you're a joint venture. And so what it appears is that the rules would allow, even though we don't have guidance on this, it would seem that if you have that situation, that each spouse should be able to use their own Schedule F to apply for the loan, because if they were in a partnership, each of them would have their own partnership income, and it would not be fair to somehow dock them. So it would seem that both Schedule Fs would count in that particular situation. So how's the money coming? I had to turn these slides in last week, so I don't have the updated numbers over the weekend, but it does not appear that the money is running out at a rapid pace. So, work with your lenders, work with your advisors. If you qualify, make sure that you get in the door and get yourself in line. Just one thing to remember, right? All this, just like all other government payments, it's public. So there's databases. If people Googled your name, they would find your name and business, and they would find how much money you received from the PPP. So just keep that in mind. Now, a biggie that was brought to us by the Consolidated Appropriations Act that has made everything so much nicer is the CARES Act. From the beginning said that forgiven PPP loans were exempt from your income. It meant that you didn't have to put them on your tax return. That's what we want, right? But IRS had stepped in with some frustrating rules that said because this was exempt money, tax-free money, you were not going to be eligible to deduct the expenses associated with the proceeds that you received. So if I used my PPP loan to pay my employees, I wouldn't be able to deduct those employee expenses. Well, Congress listened again and said, okay, we don't want it that way. We want it to be tax-free, and we want our businesses to be able to deduct the expenses. So they changed the law. And so now our PPP expenses are deductible just as they normally would be, just as if you paid for them out of your regular business account. And it also means that if I'm in a pass-through entity, if I'm in a partnership or an S corporation, that my basis gets to increase at the time that the loan forgiveness happens. It's not going to be denied to me. It's treated just as any other tax-exempt money would be treated, so that, there might be some issues where you cross a year where you might have some loss issues, but work that out with your tax advisor. It's really great news. And the other thing that happened is some people received EIDL advances, right? Economic injury disaster loans were made available to farmers for the first time. And part of that program was, we're also going to allow you, if you apply for an EIDL loan, we're going to throw this new benefit in that's going to give you up to $10,000 of an advance. The advance was just a grant. So you'll hear it called an EIDL advance, or you'll hear it called an EIDL grant, but many of you probably received this, where it was $1,000 per employee up to $10,000. So it might have been a small amount, but originally this amount was supposed to reduce your forgiveness of your PPP loan. That rule got thrown out. So if you applied for forgiveness, your forgiveness was reduced by an EIDL advance, you're going to get that money back from your lender, because the SBA is remitting those funds to the lenders. And then the other really great thing about the law was these EIDL grants were not tax-free when they were initially implemented, but the new law changed that. So if you received a $1,000, $3,000, $5,000, $10,000 EIDL advance or EIDL grant, that money is tax-free as well. What does that mean? You don't get a 1099. You don't put it on your tax return. It does not impact your deductions. It is truly free money, and it's really a very helpful, nice thing. So that's PPP. We don't have a lot of time, so I'm going to move on. I'm going to trust that Jessie will interrupt me if there are big questions out there. I want to be able to.
I have 3 questions.
Yeah.
Okay. So we have a question coming in that says, my husband and I both have an LLC. Mine is for our farm, and his is a livestock feed business. We file our taxes jointly. We did not apply or file a PPP loan because he doesn't take a salary, and I pay him a very small amount of salary from the farm, and she does not take a salary. Would we be eligible to go back for a first loan?
So from the sounds of it, and I can't see your Schedule F or your Schedule C, but yes, you would be, based upon what you've said, and you have to go check with your lender, or a tax advisor is a great person to check with initially, somebody who understands the tax returns. But the key thing is, each person who operates a business, there is a max of that 20,833 across all lines of businesses. And there are also affiliation rules that apply as well. So you can work with your advisor about that, but I would definitely go check that out and see what your best option is at this point.
Okay, next question I see here is, where do I start in this whole PPP process?
Yeah, that's a great question as well. And the people who are getting you the money through the PPP are your lenders. So the lender is where you go. You would typically go, you can go to any lender that you want. You can go to your regular lender, and if they scratch their head and go PPP what, then find a new lender. But most lenders, most agricultural lenders are very engaged in this already, and they absolutely know what they're doing. But the key is, you would likely need to involve your tax professional as well, because you're going to need your tax return information, and they also are very much a huge part of this process. So your tax professional is key to this in terms of helping to explain to you what you'd be eligible for, helping figure out how your application would work, and getting you the documents that you need to be able to prove your payroll, prove your owner compensation amount that you're entitled to, etc.
All right, Christine, the last one that I have right now is kind of a big one. So this one says, what is your opinion on the Biden tax proposal as it pertains to estate taxes and capital gains on agriculture?
So that's a great question. And, since we don't have tons of time, I have a slide here, and I'm actually going to roll ahead to it. We can talk about the employee retention credit as time allows, but review your slides if you need information about that. And if I have time, I'll go back and talk about the other things. But let's roll ahead, because this really is important information that I really want to talk about with you all today, because I know it's kind of top of mind, and I know that there have been a lot of articles written out there in the farm press talking about certain ideas that the Biden tax proposal is. And so the first thing I just want to clarify is that we have actually very limited information about what Biden's tax proposals will be. And I know we can read articles that make it sound like it's all like in some detailed white paper somewhere, but there is no such white paper. I did write an article on our website back in October that went through the public information that we had then as far as what Biden has proposed. And it was very sketchy. He had some information on his campaign website, but it's typical political talk where it's very general. So it'll say things like, we're going to deal with capital gains unfairness, for example. Didn't lay it out clearly. A lot of the information that was written last fall about it was written by reporters who had had detailed discussions with his campaign staffers and were writing things about that. So you get to the heart of sort of his ideas, but we don't have any details that have actually been proposed. We have no draft legislation that's been proposed. We have none of that. So a couple things I want to talk about with respect to this. Oopsies, I think I went the other way. All right. First of all, what do I expect this year? And you ask my opinion. Well, what I'll give you is my thoughts and projections in terms of what I think is going to possibly be happening over the next couple of years, and then where some of the sort of danger areas might be for some particular farmers. And so, first of all, I think all eyes right now are on COVID relief. And so, as you know, Congress has got this impeachment thing going, but then they're also at the same time working on stringing together a $1.7, $1.9 trillion COVID relief package. It will likely get taken smaller, but maybe not. Maybe it could be taken larger. You never know where that could end up. Lots and lots of money in that. That would increase child tax credits from proposals that are on the table. It would put out a whole nother round of these economic impact payments, the stimulus payments. I mean, just lots and lots of money. That's going to have to be paid for somehow. The CARES Act is going to have to be paid for somehow. The Consolidated Appropriations Act is going to have to be paid for somehow. So some of the short-term projected changes that we could see even this year might be to unwind some of the Tax Cuts and Jobs Act programs that were put in place at the end of 2017 for the 2018 tax year. Those didn't impact a lot of people, maybe in the farming audience, but it would change some of the net operating loss rules, business loss limitation rules, that type of thing. But what about down the road? So here's where the here's where we're all concerned, right? And here's where we have no detail, because all these things have been proposed, but nothing with detail, and some of them are mutually exclusive, right? So one of the big things that he has said that he would like to do is to have a capital gain rate increase. What would that mean? It would mean that capital gain would be taxed at ordinary income tax rates. Now remember, anything he proposes has to get through, at this point, a Senate that is evenly split, with the only deciding vote being Vice President Harris. So we have some Democrats, like Senator Joe Manchin is kind of the key one from West Virginia, who kind of thinks in a lot of ways like a typical Republican. And so anything, they've made it so that they'll be able to get things through with a 51 vote, even though typically you'd have to have 60 votes, but they've changed the rules so that you can get it through with a 51 vote. That's how the Tax Cuts and Jobs Act went through by Republicans. But you still are going to have enough support to get it through. So will we have enough support to go from 23.8% capital gain to what would be up above 40%? Because we would go back up also. The proposal would be to go from a 37% top individual tax rate to a 39.6% top rate. And then you have to add on that 3.8% net investment income tax that we have. So that's one thing that's on the table. Another one that's really big is, what about the whole estate tax? What about the whole death? What about all of that? Well, there's a couple ways they could go on this, and they've kind of proposed both. One would be eliminate the step up in basis, which would be big, right? I see more likely in the short term to lower that estate tax exemption that has gone really high, right? So we're over $11 million per person right now. I see that being lowered. But then another proposal that would really be hard for farms, and I cannot see this passing without an exemption of some kind or a high dollar amount, but proposal would be that death or gifting is a recognition event. What does that mean? Well, instead of worrying about no step up in basis, it would just trigger the tax. So if I had land at $5,000 an acre and it's now worth $10,000 an acre and I die, we're not talking anymore about not stepping the basis up to $10,000. We're now talking about tax owed on the $5,000 difference. Now that would be pretty devastating. I can't really see that going through fully, but that has been the proposal. And then eliminating like-kind exchange, you know, the whole swap, drop, drop, swap, swap, drop. Like, those are the things. And I'm out of time, but we could talk all day about this. But just know nothing is certain. These are all just proposals, no white paper, nothing detailed, very vague proposals at this point. Stay tuned.
Thank you so much, Christine. We appreciate it. Sadly, we are out of time, so we will have to stop taking questions now. But We appreciate all of the insight and everything you've been able to help us understand better today. I'd like to remind the audience that if you are a